Now I would like to invite Professor Young-kwan to chair the second panel on the Northeast Asia situation. Please join me and welcome him on stage.
Thank you very much. After listening to very interesting and enlightening discussion on Southeast Asian economic situation, we are now beginning the second session, which will be focusing on Northeast Asian session. As we have heard from the previous sessions, and protectionism has been one of the key words discussed, and it has been affecting international economy in this region as well as in all over the world. And one of my personal interest is how Northeast Asian countries will respond to this kind of protectionist initiatives taken by President Donald Trump in the United States. All those three distinguished presenters will be free to talk on whatever subject they have chosen. But in addition, I would like to ask them to speak on this subject also, because I think how Northeast Asian economies will respond to this kind of protectionist trend will influence the global affairs very much. Personally, I'm concerned about the possibility of global political economy nowadays becoming similar to that in the 1930s. I mean, populism, trade wars, the weakening middle class, polarization of economy in each countries, or something like that. So, I mean, we are looking forward to discussing this issue very much. And I would like to introduce three distinguished presenters first. Professor Dwight Perkins of Harvard University. He is the Harold Hitchings Burbank Professor of Political Economy, Emeritus in the Faculty of Arts and Sciences of Harvard University, and previous position at Harvard include Director of the Harvard University Asia Center, Associate Director of the East Asian, now Fairbank Research Center, Chair of the Department of Economics, and Director of the Harvard Institute for International Development. He has authored and co-authored or edited 20 books and numerous articles on economic history and economic development with a special reference to the economies of East and Southeast Asia. His topics include the transition from central planning to the market, long-term agricultural development, industrial policy, the underlying sources of growth in East Asia, and the role of economic and legal institutions in East Asian growth. He has served as an advisor or consultant to the governments of Korea, China, Malaysia, Vietnam, Indonesia, and Papua New Guinea. He has also been a long-term consultant to the World Bank, the Ford Foundation, and various U.S. government agencies, including the U.S. Senate Permanent Subcommittee on Investigations. He received his BA from Cornell and his MA and PhD in economics from Harvard. Next speaker will be Professor Kiyohiko Nishimura. And Professor Nishimura is emeritus professor of economics and distinguished project research fellow at the University of Tokyo and a professor in the National Graduate Institute for Policy Studies, GRIPS. He was previously deputy governor of the Bank of Japan for 5 years until March 2013. He received his BA and MA from the University of Tokyo and PhD from Yale University. He was an Arthur Okun Research Fellow at the Brookings Institute in Washington, D.C., before joining the Faculty of Economics at the University of Tokyo in 1983, where he was an associate professor and a professor. He was jointly appointed as Executive Research Fellow of the Economics and Social Research Institute of the Cabinet Office of the Government of Japan between 2003 and 2005, before joining the Bank of Japan as a member of the Policy Board and then as Deputy Governor from 2008 to 2013. His work and speeches on demography and economic policy have been cited widely, and policymakers around the world have increasingly been recognizing the urgency of the problem. And third speaker would be, Professor Thye Woo. And Professor Woo was appointed the founding president of the Jeffrey Chia Institute in 2014. And he is also professor of economics at University of California, Davis, director of the East Asia program for the Earth Institute at Columbia University, and a member of the International Advisory Council at the Center for Social and Economic Research in Europe. In addition, Professor Woo holds academic positions at the Penang Institute, the Central University of Finance and Economics in Beijing, and Fudan University in Shanghai. He asked me to simply introduce him as the president of JCI, but I read this to show that he is a really worldly renowned, scholar and economist. His affiliation is with Davis, Columbia, and Beijing, Europe, Shanghai, 5 or 6 places in the world. So please join me in welcoming all these 3 distinguished speakers. First, Professor Dwight Perkins.
This, in a sense, is a transition lecture between the Southeast Asia and Northeast Asia, because I'm not going to talk primarily about the Chinese economy or the Chinese political economy. Thye Woo asked me to talk about the contest between China and India over and how it affects ASEAN and Southeast Asia. And that's a topic which, frankly, I hadn't thought much about, but one of the ways to think about a topic of that sort is to actually have to prepare a lecture on it, and then you have to think about it at least enough to get a coherent set of thoughts together. So I'm going to make just really a few very simple points. The first point will be that it's really not a contest between China and India in ASEAN, because if that's the case, China's winning it hands down in terms of its influence on the region. And I'll try to show what I mean by that in terms of the economic involvement of the 2 countries in the region. But then I want to move on. I want to show just how big the the second thing is really to show how large the Chinese influence in economic terms is on the various countries of the region. And then I'm going to turn to the One Belt, One Road initiative of China and talk about that and its relationship to Southeast Asia. And while I'm going to be looking at the economic impact, one has to keep in mind that particularly when one gets to the One Belt, One Road initiative, that is actually now a fundamental sort of way of shaping Chinese foreign policy. So the One Belt, One Road initiative has a major economic component to it that is important to the Chinese economy and may be important to some of the economies of Southeast Asia, but it also has a major political security component to it. And I want to talk a little bit about that and how and whether that's a good thing or not so good thing for Southeast Asia. So I wish I could see the whole big thing. I would. The basic point, the first point, is that the reason why China's involvement in Southeast Asia is so much greater is that the Chinese economy has been growing faster for far longer than has the Indian economy. And even in recent years, when the Indian economy has picked up and is growing, is finally growing at a fairly good rate, but even in recent years with the Chinese growth rate coming down, the Chinese growth rate has matched, in percentage terms, has matched or actually exceeded that of India. And the result of this is, in terms of total GDP, is that China's GDP is 4 times that of India. And going with the enormous gap that has grown between Indian and Chinese GDP is that you see an enormous gap in the exports and in imports of the two countries. These are the total exports and the total imports of China. And again, you're dealing with the enormous trade of China and the more modest levels, but still growing, I mean, by any reasonable standard, growing fairly rapidly of India. And while there's a common view that India really has been somewhat hostile to foreign trade and has restricted foreign trade, in fact, the share of foreign trade in India in GDP has risen pretty much up to about the level where the Chinese share in GDP. So the reason why the trade is so much larger in the case of China than India is simply that China has been growing much faster for much longer, and therefore, given 20% or so of trade, means a much larger trade. Now, the question then is, what's the impact of all that on ASEAN and on the Southeast Asian countries? And in here, frankly, I think there's not a whole lot of point in talking for very long about India. Here is the ASEAN trade with China and India, the ASEAN trade within ASEAN, China, and then India, again, a very tiny fraction, more than 4 to 1 on both imports and exports. So it's basically a story about China's trade and influence in Southeast Asia. By the way, I apologize for some of these slides. I'm a klutz when it comes to making PowerPoints, and so I don't always get things in line. These data here basically are showing you what is the share of Chinese trade in in the trade of the various Southeast Asian countries. And what you can see as you move just even from the short period from 2004 to 2015 is that China's share in the trade of most of the countries of Southeast Asia has risen very rapidly. and in some, I mean, in one country, particularly in Myanmar, China really is overwhelmingly the main trading partner, but it's a major trading partner in the Philippines and in Malaysia, and so on. And in fact, it's the largest trading partner. Now, if any of you actually start fooling with these data, I want to tell you one thing. There's one caveat. I didn't have the energy to go into each individual country's statistical handbook, but I had the Chinese statistical handbook. And so these trade data are based on Chinese exports and imports to the different countries. But the Chinese, of course, report exports, their exports, FOB, freight on board, and their imports include cost, insurance, and freight, CIF. And that means that if you actually apply that, as I do in the Malaysian case, it somewhat exaggerates you have to do it properly, you would have to convert Malaysian imports from China with cost, insurance, and freight, whereas what I have them FOB, so it understates the exports of China to Malaysia and to the other Southeast Asian countries, and it overstates the imports from these countries. That said, the basic pattern is very clear: an enormous increase in trade between Southeast Asia and China. Now, then the question is, well, so what? Well, let me go in the right direction for a change. We could go, in this context, we could go at length into the whole question of Chinese competition. Obviously, for the poorer countries of Southeast Asia, Chinese competition is not a major problem. They are actually beneficiaries of the fact that China is not becoming competitive, is actually losing its competitiveness in labor-intensive products, and so they're moving to Vietnam, some other parts of Southeast Asia, and of course to Bangladesh and so on. So the labor-intensive areas are benefiting clearly from China. China, on the other hand, with the more high-tech areas, is clearly rising rapidly, is competitive in those, and conceivably could provide very substantial competition for Malaysia, for Thailand, and so on. But this is sort of normal. This is normal economic trade relations, and you benefit, and you have some that benefit and some don't. But I'm also interested in what is the strategic interest of China, and how is China likely to use trade and its other economic activities for more than just the economic benefits of China. And to do that, it makes more sense in my mind to look at the One Belt, One Road initiative, which is really this organizing principle of a great deal of Chinese foreign policy, as I've said. And Chinese foreign policy has an economic component to it, a major economic component to it, but it also has a major security and strategic component to it. And so the question is, where does Southeast Asia fit in to One Belt, One Road, and how does it fit into the Chinese strategy? In terms of the Chinese economic strategy, the One Belt, One Road has one enormous advantage. We talked earlier in the previous panel, the Chinese very large scale production of steel and the like, and dumping it on the rest of the world from time, and so on and so forth. Thye did that far better than anything I could do. But what China has, of course, is this enormous capacity in things, in anything connected to construction. And so the One Belt, One Road initiative is by definition a huge construction project. And therefore, for China, one of the ways of using this enormous capacity in the construction area is to basically start using that construction all over the rest of the world. And so you get new financing mechanisms, the Asian Infrastructure Investment Bank, and other kinds of activities of that sort that are actually helping China keep an industry that otherwise was in really very bad shape. And China basically built this huge capacity in construction, largely during the period from about 1995 to 2010, and during that period, that kind of construction capacity served a very useful purpose in China. Specifically, much of Chinese investment, about half of Chinese investment, was going into one, housing, and two, transport infrastructure of various kinds, and also office buildings. And the reason for that was that during the Soviet-type economy era of the pre-78 period, one of the characteristics of Soviet-type economies is you spend no money whatsoever on housing, or as little as you can, and you spend very little on transport. You wait until the railroad's ready to break down, and then you finally pull yourself together and put a little bit of money in. Well, the difference is that China, when you get into the period in the late 1990s and after 2000, China all of a sudden finds itself, because of its slow growth in personal consumption, household consumption, it finds itself with an enormous level of investment, far greater than it needs to manufacture consumer goods or the capital goods to produce consumer goods, either for its domestic market or for exports. And the question is, what are they going to spend it on in order to use all this capacity? And the answer was they built up housing, and they built up transport infrastructure. And so when I was first in China in the People's Republic in the 1970s, the highways were, a few trunk highways were 2-lane highways that were paved, and most of the other highways were gravel. You now travel through China, and there are high-speed, limited access highways all over the place, and you have the longer than the American interstate system. You have high-speed rail, longer than all of the European high-speed rail put together, and so on. You have a magnificent first-world transport system, and whereas in in 1978, the average family of 3 had about 20 square meters of space to live in, that is 200 square feet, and that was for everything: living room, bedroom, toilet down the way, maybe a small kitchen or a shared kitchen. Now you have the typical apartment in the urban areas is well over 100 square meters, or about 1,000 square feet. So you built all that up and used it, but then all of a sudden you were reaching a point where there was no longer demand for continued expansion domestically. And the One Belt, One Road comes in at this point as a way, among other things, is solving that kind of problem. And it remains to be seen whether it's going to be, how effectively it's going to be in that regard. But the One Belt, One Road, as I say, is also an organizing principle for Chinese foreign policy more generally. And a big part of Chinese foreign policy has a very large security, political security component to it. And the bottom line of the Chinese security policy as it affects East and Southeast Asia is that the first thing China wants to do is push the U.S. And the U.S. military as far away from the Chinese mainland as possible. And they want also to create, as much as possible, friendly countries around their periphery. Now, pushing the U.S. Navy off was largely accomplished through, is largely being accomplished through military, development of missiles and so on that make it. Whereas in the years in the past, you could imagine America. In fact, you didn't imagine that American carriers would sail through the Taiwan Straits. Generally speaking, as a military effort, going through the Taiwan Straits with a carrier is not a very good idea these days if you are actually thinking about any kind of combat operation. But in terms of the question of Southeast Asia and Central Asia, then the whole involvement of China in these efforts, it builds a relationship with the countries of Central Asia and with Southeast Asia, that in effect, it doesn't tie them to China, but it gives China a positive and generally major involvement that goes with the very large trade involvement that China already has with Southeast Asia and with the development of transport will have with Central Asia as well. And the answer, is that a good thing or a bad thing? Well, if it's basically economics, it's fine. It's a good thing. You get infrastructure. Personally, I see no real danger to it as long as China is basically using one belt, one road in a fairly rigorous commercial way, which in the countries that have rigorous commercial development standards and so on the whole, China so far is doing it. The danger that comes, and it's something that in conversations I've had over the years with some quite influential people in Vietnam, the fear they have is that China will then use that, all of that involvement, and they will use the fact that there's a great deal of corruption in Vietnam, as there is in a lot of Central Asia and other parts of Southeast Asia, that will be used to basically, to put it bluntly, buy political power that will, within these governments, and to shift the foreign policy more favorably toward China. And the more that happens, the more the question then comes is using it to carry out the policy of trying to create, not satellites or anything like that, but create friendly countries that basically, to some degree, do the bidding of China internationally through mechanisms of that sort. I don't see any evidence that yet is happening in major places, but you also see that the One Belt, One Road now has a number of ports, and you have a military base in Djibouti, but you also have plans for a military base in Pakistan where the major port that they've developed there. And the strategic elements of the pipelines from the port they've built in Myanmar to go up as an alternative source of oil. You can see China's strategic vision here is to also, in this particular case, protect the oil pipelines between the Middle East and the U.S. so that they don't get choked off by somebody blocking the Malacca Straits and things of that sort. So I think, going forward, the main interest and the thing to follow, because we're really in the very early stages of it, is to what degree this whole effort of this, the massive involvement of China in the region is inevitable. I mean, when you have that big an economy and that successful economy, you're going to have a lot of trade, you're going to have investment, and the question is, how is it going to be used for things beyond the economic development sphere? And the answer is I don't know, and I'll be interested in watching it in the years to come, at least to the extent at my rather advanced age, I'll be around to watch. So thank you very much.
Thank you for coming, and dear distinguished guests and the other participants. I was asked by Wayne to present anything I want. And so I first thought that the present situation in the developed countries, especially United States and also Japan, and I realized that I might change a bit the focus. So the slides is all about the first part is the current state of the world economy, and then the second part is kind of major concerns of Bank of Japan and also the now beleaguered Abe government, which is under attack of the opposition parties because of the scandals. So I will change a little bit in focus to explain what the most of the market participants think about Trump administration policy, which is a little bit different from the one we had in the last session, and also at the same time the current kind of thinking of the kind of developed countries' economists with respect to the kind of the possible kind of danger or opportunity in the political economic situations there. So my first point is that right now the U.S. economy and the Japanese economy and also the European economy are in good shape. And the background is that we had a kind of a global stagnation, but since last year, it's a synchronous expansion, and as explained in the previous session. And the anemic growth is now a steady pickup, and the most important things, we are thinking of not only the GDP terms, but also in labor market conditions. And especially in the United States, the labor market condition is very important, and also the case in Japan. And finally, I will show you the very subdued non-accelerating inflation below target. So this is the real GDP growth from 2005. And the left-hand side, you have the United States, and right-hand side is Japan. So forget about before 2016. And after the bottom of 2016, we see a very kind of steady increase of GDP growth. And just before the election of Trump, we see a kind of the natural recovery from the very long-lasting effects of the financial crisis of 2007 to 8. And so this is something like this. It's in the kind of best time, and and also at the same time, if you look at the unemployment rate, the left-hand side is the United States, and the right-hand side, Japan. Yes, we have kind of different, the levels, but the movement is the same. And now the United States, unemployment rate is very close to 4%, and which is in any case less than the so-called NAIRU, non-accelerating inflation rate, unemployment rate. Right now, Japan, it's unemployment is lower than 3%. It's quite a big the change. And this is called Okun's law, but I will show you this chart because this shows a so-called equilibrium unemployment rate. And on the right-hand side, on the left-hand side, we have the United States, and on the right, the vertical axis is the GDP growth rate, and on the horizontal axis is the change of unemployment rate, and this is called Okun's law. Actually, I'm the Okun fellow, so I have a pretty good affection over that. But anyway, the point is that the GDP growth rate, which corresponds to the no change of unemployment rate, that is a kind of equilibrium rate of growth, which is very close to the potential growth rate. And if you look at the US numbers, it's about more than 3% in for a very long period of time, and then it's going down, and in the bottom of the recession or the kind of stagnation, it's about 1.4%, and now it's picking up close to 1.5%, and we will see the next few GDP figures, the number will go up again. And this is also the same in Japan. Yes, the level is different, but this shows that the potential growth is now recovering. And there's a kind of a hunch in it. Actually, if you put 30 basis points on the Japanese numbers, then you get a Bank of Japan estimate of potential growth. And however, the wage Phillips curve, if you look at the Phillips curve, which on the left-hand side, the United States is the wage inflation rate and the unemployment in horizontal axis. Wage Phillips curve it's going downward to the right, but it's becoming less and less steeper, and so it's flatter. So it's very close to flat in this recovery, and it shows as finally picking up in recent months. But anyway, this is the way it is, and the end result is inflation. The left-hand side is a PCE core inflation, which Federal Reserve is looking at. And the right-hand side is a Japanese CPI core inflation. And it's far less than the target. And my point is that this is the kind of normal, the background of the normalization we have right now. So in some sense, actually, what is in the policymaker's mind, both in the United States and in Japan? So expansion without wage inflation so far, and even though we have the extremely tight labor market, and actually in the United States, it is very hard now to find workers, especially in services and mostly kind of hospitality business. And however, there are sizable demand shocks now and ahead despite a tight labor market. That is substantial tax cuts in the United States. And so in the United States, the Federal Reserve is up to the so-called normalization. And the so-called normalization is based on the normalization of economic conditions. And they are concerned about being behind the curve. So you have a very tight market, and the inflation is not picking up but also the wage inflation is still subdued. But the point is that the monetary policy has a very long lag, long and also variable lag. So in order to have a kind of good prospect of the future, and especially kind of dampening unnecessary up and downs of economic conditions, you should be very careful to kind of preempt the market by a kind of gradual, a kind of measured pace of inflation rates. And in the case of Japan, it's a little bit different, but the basic idea is very close to that. We have now, even though the labor market is very tight, but we see export recovery and the so-called Olympic boom in Japan before 2010. Yes, we are not in the way similar to the United States with respect to the normalization, but the economic conditions are better than expected 2 or 3 years ago. So the so-called yield curve control, which controlling the rates on 10 years, almost zero for that will produce a very stimulative effect to support expansion. That is the Bank of Japan thinking, and that is the central bank's thinking. But all depends on the kind of idea of the recovery is literally kind of supported by a very low interest rates. I vividly remember at the height of Lehman crisis, Japan had not have any kind of stress in financial markets itself. And the global financial crisis for Japan is a collapse of real demand due to the collapse of trade finance, as you said, I think so. In this sense, quantitative easing, extreme form of quantitative easing, it's to make long rates, first is to supply liquidity, and also the other thing is that to put pressure on the longer end of interest rates going down sharply and to have stock markets recovered. And that is a major source. And almost all, not almost, but a very large part of demand is debt-driven, or even based on the low interest rates. So for example, the automobile demand and also the housing demand, they are all dependent on the low interest rates. So from the market's viewpoint, the real danger is that yes, we have a natural recovery, but the point is that the natural recovery, is it kind of resilient enough to have a very high, kind of rapidly rising long-term rates? And the answer of the Janet Yellen and the Chair Powell right now is that if we use a very measured pace and also at the same time to communicate to the market, and then yes, we should have a kind of the adjustment, but the adjustment is not overblown. That is their idea. So, and the major risk is that the market will react quite abruptly, thinking that the Federal Reserve is far behind the curve. And then they had they may have to increase interest rates higher than expected and more frequently than expected. That may cause the volatility, and that is what we saw. And from the Japanese viewpoint, the Bank of Japan is subscribing to the U.S. counterparts, and they think that the U.S. increase of interest rates is beneficial for Japan because there is a kind of interest differences, and that should be translated into exchange rates. And then the point is that, unfortunately, exchange rate markets are not cooperative to this kind of thinking. And now we have, even though the United States is pushing interest rates up, we see the weakening of US dollars. There might be a kind of short-run factors like repatriation and other things, but things, the anxiety is somewhat expressed in this way. And from the Japan-specific policy concerns, there are two. The North Korea and the Chinese economic conditions are still major concerns, but they are mostly outside events which we cannot influence. So the perceived threat to sustainable expansion is kind of two things here. I'm talking about from the kind of Bank of Japan viewpoint, since I have a very good kind of connection, a very good discussion with the many board members. And the first one is the Bank of Japan's concern about financial stability issues in the long run. Since we had the quantitative easing for almost 20 years, and also now the yield curve control, which are pushing down the long rates zero, and the shorter terms it's negative. And then this is the major problems of the financial stability. The most kind of telling thing right now is a plight of regional financial institutions. On the left-hand side, you have the change, the historical change of loan deposit spread. It's going down quite sharply, and in 10 years you have almost 80 basis point decline. And on the right hand side, this is a forecast of the next 10 years, and there's a kind of two scenarios, kind of so-called best scenario and the worst scenario. But in any way, even the best scenario, we have some kind of big problems in regional banks. And this is taken from the Deputy Governor Nakaso's speech. And so in this sense, the financial stability issue is a major concern, and look at the center. This is the medium to long-term expected default frequency ratio, and it's going up quite sharply. So in the short run, on the left-hand side, short-term expected default frequency, it's kind of subdued, it's controlled. But in the future, so the possible future, it's a very big problems of financial stability. So as of December 2017, before stock price volatility, the Bank of Japan tries to communicate with the financial community that we should we shouldn't, they shouldn't say that it's a kind of the curtailment of quantitative easing, but we should have some kind of adjustment, small adjustment, making more palatable, making the current QE more palatable to the kind of regional banks, and also this means that the major banks also. But right now it's a kind of major problems of uncertainty, and especially kind of volatility in the market. So and especially the volatility you see is in the in the exchange markets. They are kind of shining off of from this kind of thinking, but the major stress is that if you go, if you kind of press a quantitative easing further, then the financial stability issue is a problem, and also at the same time, so-called the financial intermediary function of banking sector or financial sector in general is it's becoming in bad shape, and so that is kind of the idea of Bank of Japan. And the Prime Minister Abe's concern is about consumption taxes. And so we are now in the kind of the good also the global kind of upturns. So this is very good for Prime Minister Abe. So even though the Governor Kuroda, it's not his first pick, but Abe reappointed Kuroda. But the major concern is the consumption tax. Okay, the consumption tax, the history of consumption tax is always a problem, and the consumption tax hike always associated with the big downturn. And it's so 1989. It's also the 2014, and Abe took the opportunity for his survival as a prime minister. So he postponed twice. And then the end result is something like this. This is national debt to GDP ratio prepared by the Ministry of Finance, and that is important. So it's very high, and so there's a major concern. But from the Abe's viewpoint, and from the kind of outside viewpoint, it's quite likely that either two options will be on the table. The first option is that kind of a massive infrastructure spending financed by the JGB new issuance bought by Bank of Japan. And the second one is just postponing the issue, postponing again the consumption tax hike. So all in all, the present situation in Japan is good, but the prospect is a little bit shaky. And back again, and then I will talk about the United States, and the United States from the kind of financial markets viewpoint is that yes, the kind of Trump administration is kind of doing the somewhat heretic kind of policy of putting lots of stimulus when the economy is booming. So this means that the economy should overheat itself, and it should be countered by the Federal Reserve unexpected hike of interest rates or so on. That is their kind of fear. But at the same time, if you look at the wage rates and inflation, it's still tamed. And because of the kind of the structural change in the U.S. labor market and also in the Japanese labor market, the jobs jobs created. It's not in the high wage jobs. It's a low wage jobs, so in that sense, if you look at the wage increase, it's not going to be up right now and in the foreseeable future. So in that sense, the people are counting on that. We do not see any kind of acceleration of inflation. That is the U.S. market, and that is also the Japanese market. So they are counting on the kind of old normal in inflation front and the new normal in GDP growth. So, but these two might not be coincide. We will see which way we will go in maybe the next year. Thank you.
Thank you all very much for your support in attending today's event. I thank the members of the International Academic Advisory Council for their strong support for JCI. Today I'm going to talk about two new situations that China is facing, one on the domestic front and one on the economic front. Apologists and friends of the Chinese government would say it is because of these two new economic situations. That's why you have a new political normal in China that has followed to deal with the new situations. I think that the relationship between the new economic normals and the new political normals is are quite unrelated. And let's confine myself to talking about economics, and even then to talking to one aspect of each of the domestic new normal and the international new normal. The domestic new normal, the primary appearance is that the economic growth rate of China has come down quite significantly. The average since the opening and reform up to 2000 to 2010 was 10% a year. But beginning in 2011, the economy has not returned to the average of 10% of the last 30 years. So when it fell to 7.7 in 2012 and 2013, the Chinese government identified this slower growth rate as structural in nature, largely because of the exhaustion of cheap labor. There's no easy gains in output, the productivity gains to be generated by transferring a low productivity agricultural worker to a higher productivity industrial job. That gain is no longer there. The second one is the demographic dividend. The workforce has relatively large, and the dependency size of the population is small. That is changing. China is now an aging economy. So in early 2014, the government said, we are entering a new normal. And at that time, the new normal, while not defined, was seen to be no more than 7% and possibly 7.5 to 8%. And when the economy fell further in 2014 to 7.3, Justin Lin, former vice president of the world, chief economist of the World Bank, said that the growth rate of China should be 8% for the next 20 years since 2008. So basically, what we see now is unnatural and due to a failure of courage to conduct responsible fiscal and monetary policy the government is not pulling up the economy when it ought to be. And then, as time went on, the growth rate has dropped. I'm going to make the case that the slowing down in growth has to do with that structural conditions in China can no longer support a trend growth rate of 8%. And if it's to come anywhere near that, you have to confront some very big structural reforms. You could see another way of the problem is that China has had a lot of investment. Look at cement, look at iron. The production capacity went up by 77% for iron and went up by 65% in cement. That is growth, expansion in production capacity. But unfortunately, that is accompanied by an increasing rates of underutilization in these key industries. Since all this expansion in production capacity were financed by bank loans, the fact that you are not using the extra capacity that you have created, that means that you cannot service your loans. So there are bad loans appearing in the banking sector. Officially, the number at the end, in the middle of 2016 was 1.6%, but most investment bankers would put it at closer to 20%. And I think that today it will be closer to 25%. Now, where did all of these problems come from? It came from the two things I say: exhaustion of cheap labor, exhaustion of the demographic dividend. And all of this was pushed to the front when the government undertook extremely stimulative spending in 2009-2010. When the Lehman Brothers collapsed, Bush Jr. saw that this is a global financial crisis on the level of 1929. In order to prevent it, the G20 as an organization had existed for 15 years prior to that as a meeting of ministers of finance. The heads of state came together for the first time in November 2008. And the mantra that they all went home with was, we will all stimulate our economies together. Wen Jiabao came back and said, China will do its duty. It will boost spending by 7% of GDP each year. Wen Jiabao, being the very modest individual he was, said that the growth rate in 2008, 2009, and 2010 would be 8%, greatly below that 9.5% or 10% that I had talked about earlier. The IMF, on the other hand, looked at how the other countries were expected to be, could not see how 8% was possible. Because number one, given the fact that global demand is collapsing, why should any firms increase production capacity in the face of collapsing demand? And furthermore, why should any banks lend money to permit such behavior when there is a general collapse globally? So the IMF says 6.7%. Well, when one is caught in a situation of being asked, what would the growth rate be in 2009 and 2010, being the coward I was when I was asked this question, I said, well, it must be somewhere in between, right? And I say you're somewhere in between and most likely closer to what Wen Jiabao would say. Because the key logic in my thinking was that state-owned companies are not profit-maximizing companies, they are career-maximizing companies. You take your orders and implement what you say, and if something goes wrong, You don't have to take responsibility. I was told to do this, and I did it, and something goes wrong, don't blame me. So similarly, the banks. So state firms would invest, even though they think they're not going to sell the additional output. And the banks will lend the money. After all, they are told to lend the money. You cannot blame them for implementing orders of the party and the government. And this is largely because they expect to be bailed out when they get into trouble. This is what that is called the soft budget constraint. They face soft budgets. This is when it's state-owned companies. But in Malaysia, like during the Asian financial crisis, when we have the soft budget towards private firms, that is called crony capitalism. So if you bail out state companies, that's called soft budget. If you bail out private companies, it's called crony capitalism. So I said, given the logic of the soft budget constraint, they'd be closer to what Wen Jiabao than the IMF. Well, I was clearly more afraid of contradicting the big man than in following my own logic. My own logic would say they would invest like mad and the banks would lend like mad. So why should 8% be the norm? That should be much higher. That's what the logical conclusion of what I said. Well, the truth was growth turned out to be 9.2 and 10.6 in these 2 years, greatly exceeding Wen Jiabao's prediction. So what's the negative outcome? Well, because if you ask yourself, China implemented this fiscal stimulus not because the government undertook massive infrastructure investment. And the high-speed railroads, for example, needed a lot of cement, a lot of steel. And the government said, we'll do it in 6 years. We'll do X thousand kilometers in 6 years. And I need that steel and need that cement. If you were a private company, you would not take that order. Why? Because after 6 years, who's going to buy the extra amount of cement that you have online? And who's going to buy the extra iron you have online? But if you're a manager of a state-owned company, if you've done a good job during that period, you might be promoted to another company. And if the old company falls in trouble under the new guy, it just shows what a good manager you were. When you were in charge, things were well. The new guy comes in, he screwed it up. And that's why I deserve the promotion. So at the macroeconomic level, what you have is the appearance of non-performing loans that threaten the financial system, the stability. And because the government has to bail it out, the government will at the future have less money to spend on other projects. At the microeconomic level, these things are not good for productivity gains. And what is China doing? What's the basic problem? The basic problem is China's fiscal tools of fiscal and monetary stimulation are through the state enterprises and the state-owned banks. And they don't necessarily are efficient. And even if they are efficient, they are financially deficient. Because if you are efficient, then you have created a lot more money for you to steal. That's what most state-owned enterprises in the world are. Nest of corruption and political patronage. No difference, well, except in Malaysia, of course. We have Pemandu, we have Khazanah, so we don't have that kind of stuff. Except the MAS somehow has failed to fly financially. But let's come back to it. What's China going to do with its most outstanding economic problem, which is what to do with large state-owned enterprise system? That's the internal demand that has to be done. And Li Keqiang, in his plans reported a few days ago to the National People's Congress. He promised that state enterprises will be reformed to become bigger and better. There is a shift in producing national champions on the stage. So that would be hope triumphing over experience. But who knows? Things may be different this time. The other big reform of China that needs to be done, of course, is the household registration system and the collective ownership of land. But there's no mention of it in the Keqiang speech. And so, for ideological reasons, you can understand why the state enterprises problem is not being addressed. But there's nothing socialist about these mobility restrictions on the rural population. So there's likely to be more action on that front. What's the new international normal? The new international normal, as spoken by our previous speakers, is trade wars. Yes, the unhappiness with free trade is not new. Even though free trade has benefited Asia disproportionately, China is the biggest beneficiary of free trade. But China would also say it was one of the biggest victims of free trade. After all, it was under the name of free trade that the Opium Wars were started, and free trade in that case was meant that trade to benefit a specific group of multinational corporations like Jardine Matheson to sell opium to China. Unhappiness with globalization since then, the last 20 years, I think has to do with, one, the meaning of free trade has become distorted to mean greater power to the multinationals at the expense of national sovereignty, like the state investor dispute mediation mechanism, which you should look about. The other one is the people are supposed to be looking after global governance did a bad job. The IMF was effectively the bill collector for the banks in the 1980s during the Latin American external debt crisis, and it transformed a regional panic into a national collapse in several countries with the wrong policies. So that unhappiness with, one, the disproportionate bias towards the interests of multinational corporations at the expense of national interests, and the misgovernance of globalization is what that have, I think, sparked so much dissatisfaction with globalization and hence the rise of Donald Trump. But despite all the bad things I thought about globalization, I think that deglobalization must be resisted because the problems I mentioned could be dealt with without deglobalization. Now, what has this to do with China? It has to do with China because the last time that deglobalization happened, it brought disaster to the world. The scholar Charles Kinderberger tells us that protectionism under deglobalization is what that converted a regional financial crisis into a global depression. But financial crisis had happened all the time before 1929. But what was different about it in 1929? The difference of it, according to him, was that by 1929, there was no single global power that was strong enough to beat everybody into line to take corrective actions. According to him, all the financial crises before 1929, there was the United Kingdom, the global hegemon, who was able to, number one, keep its market open to soak in exports from the other countries and to extend credit to the other countries to bail them out. The UK in 1929 was no more in shape to do it. The US was big, but the US didn't have the mentality to do it. So, in the absence of a global hegemon, that it was a leaderless world, we collapsed into protectionism. So, on that hypothesis, the United States is now no longer the global hegemon because China is the same size now. Well, before we do that, how credible is Kinderberger's hypothesis that in the old days, it was the UK that kept the world together? How credible was that? Well, to be a leader, it means that you whip everybody into shape to follow your line. According to a study by Stuart Laycock, in the 150 years before 1910, there are only 22 countries that have not been attacked by Great Britain to be brought into line. Suppose it's an exaggeration, as another scholar had said, that number would be 41. Only 41 countries. The color that you see, Chile, that color are the only countries in which did not experience aggression by the United Kingdom in the 150 years before that. So question, is China going to be the new global hegemon? Well, the truth is there'll be no more global hegemon in the world today. Because today we have India, China and United States. In the future, we'll have India. In other words, there'll be no more hegemonic stability. In the absence of a big brother to beat everybody into shape, that means that the agenda for global governance in a multipolar world has to be developed because there are some rather existential threats to us collectively. Climate change, nuclear proliferation, and the maintenance of world trade. In a multipolar world like this, what must China do? There's one thing. It has responded with one belt, one road, but I think there's one thing for its own national security China will do, which is that it will push the renminbi to attain the status of the US dollar and to push Shanghai to the status of New York City. Largely because, why did Iran give up its nuclear bomb? Largely because the Americans have weaponized the international payment system. The dollar is the key international currency. And your transactions would most likely pass through a US bank at some point. So sanctions could isolate any country from the international division of labor and hence guaranteed economic stagnation. So this is a security threat that China definitely wishes to avoid. And furthermore, for the benefit of the world, we need more international currencies, reserve currencies. After all, the origin of the two large global financial crises of the 20th century originated in the United States. So on that front, while the Chinese are unlikely to do anything about the state-owned enterprises to improve the domestic new normal, they are likely, and they have been moving aggressively to deal with the new international normal of a multipolar world. So thank you very much.
Thank you very much. I think we had three very insightful and enlightening discussions, which covered Chinese economy and Japanese economy and overall economic situation in this region. So let's begin Q&A sessions. If you have questions, please raise your hand and identify yourself briefly. while they are thinking about questions, let me ask Professor Wu. You mentioned in your presentation the issue of soft budget constraints, and this is one of the fundamental problems all the state-led economic growth has been facing in the past. For example, the Soviet Union also had the same problem. Also, even South Korea had the problem, and that led to financial crisis in 1997. And what about China? Do you think Chinese government, Chinese policymakers will be able to handle that problem so that it may not explode as a financial crisis? Because I'm asking that question because whenever I asked a specialist on Chinese economy, there were two groups of people. One group of people said that, yes, probably Chinese economy will have serious problem in the financial sector because of the soft budget constraints problem and moral hazard problems or something like that. And the other group told us that, no, China is different. Chinese government has many instruments to control the situation. So I'm confused. What is your view?
Well, since we both know what the other is going to say, I guess I in terms of your dichotomy, I guess I'm in the latter category. The basic, the soft budget constraint, the non-performing loans, they aren't good, and they're I think damaging to the economy, and for reasons I'll get to, but they're not. But it's not a financial crisis. It is not a 2007, 8, 9 crisis, and the reason for it is very straightforward. All of the money is essentially owed by one Chinese entity to another Chinese entity. There's very little international borrowing, and there's some, but there's nothing. And the Chinese foreign exchange reserves are more than adequate for handling any kind of foreign exchange debt problem. And so having, the problem is, of course, while the government can simply print money. Now, when I say they print money, they don't actually go down and run the presses and then drop the money all over. They create asset management companies, and they do debt for equity swaps, and they do all kinds of things that make it look like they're doing something technical. But the reality is it's simply pumping out money to bail out the enterprises that are in trouble. And they did it when the non-performing loans were 40% of, or officially they were 25%. Actually, most people think they were much higher. 1998, yeah, and so in that context, but the danger of that is you keep doing that, and you basically encourage that kind of bad behavior. And low return, investments and low returns and losses, and it's going to over time slow the growth rate down, and so it's definitely not a healthy thing, but it's not a crisis. It's not going to collapse. There are no laws in China that the Politburo can't override if they in any way restrict them. That was not necessarily the case with the U.S. and Europe. They had laws and they had politics. There is no such, none of those things are inhibiting in China. So,
well, the minor footnote I would say is that it is true that unlike what Nicholas Lardy said, that there would be runs on the banks and so forth, even though the bank is technically bankrupt, largely there'll be no runs because the owner of the bank, which is the government, is not bankrupt. The government has enough assets to bail out the banks. The cost, according to Dwight, is one of efficiency losses. I think the loss is greater than that and is actually seen as an existential threat to the system. Because you think of the cash flow of a bank. The cash flow of a bank is earnings from the loans that are still good must at least cover the cost of paying the deposits. So if there's no reserve requirements, all the deposits are lent out, then what you require is the rates of deposit times the amount of deposit must equals to the loan rate times the amount of loans that are still good. The amount of loans that are still good is the amount of deposits minus the bad loans. This means that if the bad loans is 1/3, the bad ratio is 1/3, then your lending rate must be at least 50% higher than your deposit rate. Otherwise, you cannot cover your cost. If China wants to push the renminbi to be an international currency to offset the Americans' weaponization of the international payment system, it must be the only way the renminbi can have that global key currency status is that Shanghai is a top global financial market. A top global financial market must permit the free entry of foreign banks. And the foreign banks come in, they have no bad loans, they don't need to charge a lending rate that is 50% higher than the deposit rate. So, given that, that's a contradiction. If you wish to promote the internationalization of renminbi, you cannot keep out the foreign banks and hence allow the large amount of NPLs in the domestic system. This is why Zhurongji recapitalized the banks, even though there were no danger of blowing up, because he could smell WTO coming in 1998. And when WTO comes, there'll be 10 years before foreign banks would come in. That's what the thing is. In other words, we now have a trade-off between from being safe from financial blackmail by the US versus the NPLs.
Okay, thank you very much. I'd like to ask one question to Professor Nishimura. In your lecture, you also mentioned the issue of raising consumption tax, right? Raising consumption tax is unpopular and to voters, and politicians should have strong political capital to implement that. And as we heard from newspaper reports, Prime Minister Abe has been suffering from political scandal. And will he be able to raise a consumption tax, which would be necessary to reduce the amount of public debt so that there could be more money to be available for investment in various,
Yeah, actually, I explained the two options, which is not good for the national debt position, and it's becoming something like I call it it's a kind of morphine led economy. So the morphine is something like it's more than tranquilizer. It's kind of paralyze your kind of thinking or something like that. And actually, quantitative easing of the it surpassed 20 years, and right now the yield curve control of 10-year rates has created kind of an atmosphere or kind of thinking in politicians that we can go on almost forever. And that is wrong, but so long as the yield curve control is in place, then the most politicians think that way. And the only danger that is foreseeable from the kind of economist viewpoint, also the kind of political analyst viewpoint, is that the possible exodus of Japanese funds from Japan to somewhere, the U.S. or in other countries, and then it pressured on the exchange rates. Japanese yen shall be depreciated disproportionately. The Bank of Japan can counter the kind of possible kind of upward change in interest rates, upward kind of move by buying JGBs infinitely. But they cannot counter kind of exchange rates or depreciation of Japanese yen because that means that they have to raise the interest rates very high. Except for that kind of exchange rates repercussions, it looks like the game, the present game is going on. So the most kind of probable way which will have a big impact of Japan is through the exchange rates and through the CDS, the credit default swaps and something like that. That is kind of one thing. And can I add the kind of Chinese situation? Actually, this is something close to the kind of a Japanese model or something like that. You can go on a kind of status quo, assuming that all problems are domestic, in some sense. But from the financial viewpoint, because I was at the Bank of Japan, I kind of supervised a kind of international kind of a relationship, and the very heart of the financial crisis of 2007 to 2008 is the so-called counterparty risks in financial markets, and kind of, it's global counterparty risks. So even though the Chinese problems is is confined in China, but if the Chinese banks are in the kind of global financial community, and they are the major, if they are the major players in the kind of global financial markets and having some kind of a counterparty relationship, then the Chinese originated financial crisis can easily spread to the other financial markets. And that is quite overlooked in 2007 and also right now. And remember, the problem of 2007, so-called Paribas shocks and other things, is the counterparty risks. And it originated in the United States, but it's appeared in European markets. And the source of the problems is actually the United States money market funds. Their kind of refusal to roll over the European banks' commercial papers, asset-based commercial papers. That is a real source. So My point is that the China can be a source of world financial crisis through that kind of counterparty risks. And that kind of counterparty risks is not controlled by the Chinese government. This might be a little bit technical, but in the kind of intertwined financial markets, and also the importance of MN's multinational corporations, and also the so-called global SIFI, systemically important financial institutions, and China has one or two in it, but that kind of the financial kind of repercussion, and once happens, it's a global level problems. So it is the Chinese kind of position in the kind of global financial market is growing, and which means that there might be some kind of problems in it, and which cannot be addressed by the Chinese government.
Thank you very much for your interesting point.
My question is for Professor Wu Thye.
Yeah.
You made a case for globalization from the trade perspective, but economists such as Stiglitz have argued very strongly against globalization as an existential threat, particularly with regards to the disparity in wealth distribution and social inequality. A South Asian leader has also argued that just because globalization is upon us, it does not mean that we should lie back and let our predators destroy us. So from the social and socio-economic point of view, do you still think it is not time to roll back globalization, taking a lead from Trump's protectionist policies thing?
I have a question on China and Japan. The population has begun to decline. And so one source of growth is denied. At the same time, from what I can gather, TFP in both China and Japan is also not increasing. How are these countries coping then the next 18, 24 months on keeping the economy active and alive?
On the China, I mean, the TFP productivity has fallen very sharply. And the population or the labor force growth overall is actually beginning to fall. So in that sense, the growth rate should be coming down more. And what is keeping it up is this massive stimulus effort, investment that is continued, and you can actually get into a question of how much of the GDP now is real, because a lot of it is construction of things that are really valued by the state at whatever the state thinks, wants to say they're valued at. So you build a railroad to Tibet, and you can say, the way in which it's typically measured in GDP, it's the amount of inputs that go into it. And therefore, by definition, you produce something that's worth equal to at least the inputs, where in fact it may be worth a lot less than the inputs. In which case, the GDP figure may actually exaggerate a little bit what is actually happening. Ultimately, you can't keep on doing that, but you can do it for a while. But again, going abroad with One Belt, One Road initiative is in hope of finding a lot higher rate of return investments that you can then get through these international investments. But so far, those aren't really large enough to really fundamentally. So China's growth rate should be falling. And it may actually be a little bit lower already than the official figures suggest. Not because of falsification, but because of the way GDP is calculated. That's a guess.
Can I?
Yes.
Okay. Actually, this is a very good point. First, China. Chinese growth or the Chinese all of the financial markets are based on the assumption that their economy will grow 6%, maybe 7% or something like that. But actually, my hunch is that the kind of the real growth rate might be 3 to 5%. And I had a very lively discussion with the head of the with a very high-ranking PBOC people, and we had a kind of discussion about that. And I said my hunch that in 5 to 10 years, there should be a kind of mean reversion from 7 to 3 to 4%. And he agreed. And so in some sense, I think the whole system, in the 3 to 4%, it's quite normal. And actually, that's why I say the mean reversion. If you look at the many countries and to run a regression, and then it's very likely that you get 3 to 5% for a very long period of time. And if this is the case, and then putting kind of aging and other things in it, this means that you have to have a relatively high rate of technological growth. And in the Japanese case, we had we have the kind of dwindling a population, but if you look at the TFP with respect to the kind of working age population, and then TFP growth is relatively high. So the basic point is that the first one is that you have to have kind of a large investment in human capitals and other things to keep up the TFP higher. And the other one is that you have to adjust the kind of whole system to 3 to 5% growth rate. And my kind of fear in China about China is that the Chinese financial system are not used to have a 3 to 5% kind of growth rate for 10 years or so, something like that. They all depend on the 7% or 6.5%, which is too high. And at some point of time, you will have some kind of the stress, either in the market or in the kind of local government finance or something like that. That is my point.
I think the answer that applies to both the issues that were raised is that when you move from one long-term equilibrium to another long-term equilibrium, even though the second one is better and superior to the first, the adjustment through which you move from one to another could be a painful one, which requires you basically to go through a valley of tears. Let me be specific. Adam Smith's book he praises globalization. But at the same time, he says, it is destroying the societies of Asia, making slaves of the people in the poorer countries. But, he says, they will learn to do what the oppressors know, the transfer of scientific knowledge and so forth. Over time, they will converge to the standard of living of their oppressors. Basically, what is it that the Europeans could do that Asians could not learn if they would set themselves the proper educational infrastructure and so forth? So on that front, I'd say a lot of bad things happen on the way, but it doesn't mean globalization was bad. China would have been stuck in where it was in the Qing dynasty, if not for the Opium War that pushed China to modernize in a very painful way. Similarly, Japan's population today. It's 7 times the population of the Meiji Restoration. The Chinese population is twice the size of the population in 1949. I would argue that these populations are too big. That standard of living, the important thing is standard of living. GNP per person. Why has there been no revolution in Japan, even though you look at total Japanese populations, total Japanese GDP not been moving very much? Because technological innovation been pushing up GNP per capita. So total GNP, yes, it's not very impressive, but GNP per capita, it is no worse than the Europeans, the Americans, and anywhere else. GNP per capita per hour worked. That's important because you want to control for the retired people. Per hour worked has moving up basically the same because they're all using the same technology. So I think that the bad news of Japan has been greatly exaggerated. I think that in the future, Japanese would not need people to push others into the subway train during rush hours. I think standard of living would be better. And similarly, I would say the same for China. It's a ready and overcrowded society, heavy pressure of man on nature. And I think that a smaller global population is not a bad thing.
Thank you very much for your very insightful comments and presentations and discussions. And I think I and all of us, I hope, have benefited very much. And please let me join in thanking all those 3 excellent presenters.